This is a demonstration of exercise 424, compute and interpret coverage, liquidity, and solvency ratios. Selected balance sheet and income statement information from Amazon for 2016 through 2018 follows, and the problem asks us in Part A to compute the profitability measures, return on net operating assets, and return on equity for 2018 and 2017, and to determine in which year the measures are stronger. So I have computed the ratios for return on net operating assets for 17 and 18. Return on net operating assets is going to be net operating profit after tax divided by average net operating assets. And then I've also computed the return on equity, which is net income divided by average equity. So these ratios are concerned with profitability, how profitable Amazon is. So we can see in both the return on net operating assets and the return on equity have gone up substantially from 2017 to 2018. So we can definitely say that Amazon has greater profitability in 2018. In the B portion, it states to compute the coverage metrics, times interest earned, and cash from operating activities to total debt for 2018 and 2017, and to discuss any trends. So I have computed times interest earned, which is equal to the operating profit divided by interest expense for 2018 and 2017, and the cash from operating assets divided by total debt for 18 and 17. Now these are coverage metrics. So they are to determine how easily Amazon can pay the interest on their debt and how well they can make their principal payments. So we see that times interest earned went up, which is good. That means it's easier for Amazon to service that interest expense, and cash from operating assets divided by total debt went up. So it would be easier for them to make these debt payments out of their operating assets. So since both the times interest earned and the cash from operating assets to total debt increase, we can definitely say that Amazon seems to be able to easily cover both their interest and their principal payments that are owed. In the C portion, it's asked us to determine liquidity for the company for 2018 and 2017 by computing the current ratio and quick ratio, and to determine is the company sufficiently liquid. Also, any additional information about the accounting numbers that make up the ratio that might help us in assessing liquidity. So we know our current ratio is current assets divided by current liabilities. And our quick ratio is stricter. It's only the cash and cash equivalents plus marketable securities in the numerator divided by current liabilities. We can see that both the current ratio and the quick ratio for Amazon went up from 2017 to 2018, which means that it is easier for Amazon to pay its current debts or short-term debts. So since both of these ratios increased and they're both strong, we could say that Amazon appears to be very liquid. If we wanted more information, we might want to know when the cash flows from operations are going to be realized or when the current liabilities are due, just to get more of a feel of the timing of all of these. If we wanted to compare Amazon perhaps with some of its competitors to see what their current and quick ratios are. In Part D, it states compute the total liabilities to equity ratio and the total debt to equity ratio for 2017 and 2018, and discuss any changes that are observed for each. So total liabilities divided by total equity, we have those computed for 18 and 17, and also total debt to equity. Now remember, these are the solvency ratios. So the more debt that a company carries, the riskier it becomes. So in these cases, we kind of want these ratios to be lower to a certain extent. We know that financial leverage increases return on equity, but the more debt that a company carries, the riskier it becomes. So Amazon's ratios actually decreased from 17 to 18. So that's actually a good thing. And they're in the medium range, so we would say that Amazon is solvent. So the E part asks us, what is your overall assessment of the company's credit risk from the analysis in parts A through D? Well, we saw that Amazon is very profitable and the profit is growing. We saw in the coverage ratios they have no problem covering their interest or principal payments. They're very liquid and they seem to be decreasing their debt and they're solvent. So we would say that Amazon appears to be a low credit risk. And that is the conclusion of the demonstration for exercise 424.